Welcome to TheoTrade. This is Don Kaufman. It's September 1st, 2018. You are watching the TheoTrade Weekend Update. First, hey, welcome to Labor Day weekend. Summer is over, people. Markets are effectively closed on Monday, other than a few futures markets. Nevertheless, probably not going to be a lot of volume. So we're going to go into a holiday week of trade. But for those of you, if you've been around in this business for any period of time, you know once we come back from Labor Day, it's on. It's getting a little bit more serious at that point. Everybody returns to trade. Now, in this kind of short video, what I want to do is I want to discuss a little bit about markets, and then we're going to look much more in detail when we start to get to charts. And really, I'm going to give you a little bit of a quant trader look at markets right now because, well, the overwhelming theme, if I have one for the market right now, it's not so much about the upside move. Okay, put all that aside. It's right now, quants are in control of this marketplace. And I'm going to show you again, specifically when we come to this latter portion, we're going to look at market cap, and you're going to start to notice all the volume, concentration of liquidity is into literally a handful of products. So you start to look around the marketplace, you're not going to see any liquidity other than in large market cap. Okay? The big theme is if you can push big market cap. Yeah, I'm talking about what everybody else is looking at. I'm talking about Amazon. I'm talking about Apple. If you can push big market cap right now, you can actually drive the indices themselves. Do you think the quantitative arbitrage firms are not on this? That is what is in control of this marketplace. Now, I'll explain that again in just a moment. Let's go and also discuss a little bit about expected move in the SPX. You guys kind of know, like week in and week out, I talk about expected move. That is how the option market depicts risk, okay, in this coming week. And I'll just give you a quick example. This past week, we were looking for like a $31 expected move in the SPX. That's what the options market was depicting the risk to be. What did we effectively move? Well, we pretty much hit it. Okay, nail on the head. It doesn't get much closer, and I'm going to show you that. The other aspect that I really want to kind of hammer, and I'm going to show you in a moment, happens to be, okay, that in the last 22 weeks of trade, if you actually took week by week by week, and literally broke it down week to week, the last 22 weeks of trade, only 3 times have we now crossed outside of what was expected in the SPX. So people are always looking for edge and they're always looking for statistics. Yeah, well, how does about 86% of the time we're inside of a 1 standard deviation? And you're like, wait a second, that doesn't make sense because 1 standard deviation is supposed to be 68% of all occurrences. Yeah, right now it's 86% of the time. That is effectively from April 1st to this current week. And I'm actually going to show you a couple of edges that lie in the marketplace, specifically around expected move. If, again, big overwhelming theme, quants are in control of the overall market. I'm going to show you that here momentarily. The other overall theme, okay, how you can take advantage of it utilizing expected move. Well, with that, let's get to it. Let's take a look at a couple of charts, a little bit of quantitative data. I made a fairly bold statement a moment ago on the video portion of this that quants are firmly in control, and I will absolutely stand by that. Allow me to display precisely what I mean by, hey, quants are in control of this entire marketplace. The first portion, or the first evidence that I want to provide to you is to not necessarily look at a chart. Obviously, you take a look at Apple, you're like, wow, that is astounding in terms of a move. Then you look at Amazon, hey, listen, it's the exact same move, right? So it's for the most part one and the same. So what I'm going to do is I'm going to close up this left side bar. Don't even worry about the market right now. Don't worry about, so much of individual stocks. Follow along, tune in, turn on, because I'm going to show you some interesting data. So on Thinkorswim, I'm going to cruise over to Market Watch, and under Market Watch, what I've pulled up, and I want to be very, very specific because anybody can do this. All I pulled up is the S&P 100. I get emails all the time. People like criticizing me. Why would you pull up the S&P 100? Why not pull up the S&P 500? Oh, I have a good reason, because it don't matter, because right now there's only like 5 or 10 stocks, okay, that are moving entire markets. This is actually along the lines of what we're going to talk about right now. So inside of the S&P 100, okay, what I've done is I've come in here and I've actually opened up a column specifically for market cap, right? Market capitalization.
what is this sucker worth? And we've got Apple and we've got Amazon. And then I took the entire column and I sorted us by market cap. So Apple's the biggest and Amazon. Then we come to, Microsoft and Google are neck and neck. By the way, yes, Google represents 2 spots, but it's an $856 billion. It's just shy of $1 trillion too. We got a little Berkshire Hathaway up there, some Facebook, they're neck and neck. Then you drop all the way down to what I call the $300 billion club. They just can't keep it together. Anyway, at that point, it almost doesn't even really, make a difference. So for the most part, what we're looking at, again, Facebook. We're looking at Berkshire Hathaway, which actually falls under the financials. Okay, we're looking at Google, Microsoft, Amazon, Apple. Now, when you start looking at this kind of top-down approach, really it's just Apple, Amazon that are predominantly going to be in the main driver's seat. Microsoft, though, and if again we can look at a chart on Microsoft here momentarily, you will see Microsoft kind of does fall heavily into this category as well, even though you don't think of Microsoft as like this, this behemoth because it's not a $2,000 plus product. It's not an Apple. Don't set aside Microsoft and the ability to move markets. So back over here, effectively what's being done right now is it's all about quantitative arbitrage. Now, those are some big terms and people are like, well, what is a quant? Quantitative finance, there's a ton of different genres of quantitative finance. And one of them lies in the fact, and the first thing I really like to tell people about quant is that, first of all, some quants absolutely believe in fundamentals. Some quants absolutely, there are charts involved. Yeah, maybe. But there's always huge mathematical underlying to it. And they're trying to find edge, provide edge, and trade into the edge, right? So one of the edges that they have not only figured out, but they've opened up for themselves is driving liquidity, their own liquidity in these quant arbitrage firms. They'll actually drive liquidity, which means drive trade specifically into the heaviest market cap. Why? If you can drive trade, into the heaviest market cap underlyings, let's just say 3 of them, because 3 of them represent, almost 3 trillion now in terms of market cap. If you can move 3 trillion in market cap, what can you influence? Can absolutely influence the S&P 500. Undoubtedly, you can influence the Qs, right? Which is the NASDAQ 100. So they're not trying to influence it in terms of like, is this a manipulated product? They're not trying to move it up or down. They're just trying to move market cap to open up arbitrage opportunities between the individual products, and the corresponding indices. And you can actually see them doing this on a day-to-day basis. Now, you'll see just incredible moves in Apple and Amazon and Microsoft. By the way, what I'm talking about here is nothing new. Like quantitative arbitrage and ARBs have been around since basically markets have been around. But this, I wouldn't call it necessarily like a newer version of arbitrage, but it really is what has gripped hold of this market right now. And it is astounding how much you can move, All you have to do is trade 3 products and you've got the S&P 500 or, for example, the NASDAQ pretty much under your thumb at that point. Now, a little bit more if you will, proof has got to be in the pudding. So when you start to look at moves in Microsoft, right, how linear some of these moves happen to be. And this is where I'm just displaying it in the charts, but the reality of the moves has everything to do with the liquidity that is being traded. So allow me, and again, Microsoft can be used, and we'll talk about Microsoft here momentarily, but allow me to present Apple, as kind of our marquee case. The first thing I want to show you about Apple is the sheer volume that it traded. Now, this was Friday, right? This was coming into a holiday weekend. It traded 43 million shares. They're like, okay, whatever. I don't really know what Apple trades, but go take a quick glance at Apple. All right. You can see Apple's volume has picked up quite substantially. How much so? Well, you start to look down. I also like to look at the option statistics. I think this one should actually grab you a little bit. That's 1.2 million contracts have traded. Now, the only thing you can see that's got volume like this, and Apple's like a $227 product, you have to look towards things like the spiders, which is completely insane because the spiders are one of the most liquid products in the entire known universe, right? 66 million contracts. And under option statistics, you've got 2.6 million contracts that have traded behind that. Now, again, some fairly staggering volume, okay? Just in comparison now. So we just looked at the spider versus Apple. Clearly, Apple's trading huge. Then let's go look at a product like the XLF. Now, the XLF is the financials. It's one of the most liquid products in the entire, industry, except right now, it's doing about 34 million shares. Okay, on a $28 product, which means it's not doing anything, right? Because $28 product versus, Apple, which is a 200 and, some odd dollar product. Apple is the magnitude of exactly 10 times the size of it, okay? Take a look at the chart in terms of the financials, okay? Check this out. There's almost like no volume in here right now. So as I was saying, concentration of liquidity. Right? And there's products that are in favor and products that are going out of favor. And they're actually, all these quantitative arbitrage firms are actually rotating. Right now, tech is happy. Now, let me bring you to Amazon. Okay? Because Amazon, they're absolutely algorithms attacking Amazon on a day-to-day basis. Now, Amazon is, interestingly enough, a magnitude of 10 times greater than even Apple. Does 4 million shares. But you start to put this into terms, okay, 4 million shares of a $2,000 product, that's the equivalency of, 40 million plus shares of like Apple, right? And then we've done 326,000 contracts over here, which is huge, given the fact that it's a $2,000, again, a $2,000 product. So, like, okay, so where you're going with this, if you can force capital, a very small amount of capital into a handful of products, you can actually move those products, okay? If those products move, when I say products, if you get Apple and Amazon, Microsoft moving, and you have almost $3 trillion of market cap, it's basically like, rolling a bulldozer down a hill, okay? And you'll start to actually move markets and you'll open up arbitrage opportunities. And right now, it's the name of the game for all of these firms. Now, where does that leave you as a retail client? You're sitting there, you're like, that's actually kind of some cool information. By the way, you want to see another one that's in play right now? Emerging markets, EEM. Look at that. This is one you wouldn't even have thought to look at, right? Almost 500,000 contracts over there. Emerging markets, because the emerging markets, right? This liquidity here in the emerging markets is actually capable of moving entire other markets and economies for that matter. The emerging markets is heavily into Asian markets. So at this point in time, like, you don't even necessarily have to look at Asian markets. You just look at the EEM, right? That's some of the constituent products happen to be Asian markets, but they're forcing liquidity into these products as well. However, it's quite the opposite. And by the way, what I'm saying over here with Amazon and with Apple and with Microsoft and the emerging markets, this doesn't necessarily constitute that markets are going to rally forever. That just happens to be the direction. The other aspect I want to cover before I go on and talk a little bit about the SPX, the other aspect I want to cover with this, that these firms do not necessarily, have bullish or bearish positions. So again, when I'm talking about different aspects I want to cover, people think of these like quantitative firms are like, they're just buying stock. If you ask yourself, who buys this thing at 2,000? Who does it? Who's buying at the all-time high? How about an arbitrage firm, that basically just buys the stock and then offsets the risk? How do they offset the risk? They can use the S&P futures, right? They can go out there and buy Amazon and offset it by selling S&P futures. They can buy Amazon. Why do you think I'm showing you all the option contracts? They can offset their risk in what's called risk reversals, using the options. So you can effectively have someone that's buying the all-time high over here and not taking any directional risk. That's not their game. Their game is arbitrage. It's picking up pennies, nickels, dimes in front of a bulldozer. And I got to tell you, Amazon makes a whole hell of a lot of sense for these trading firms because the bid-offer spreads on Amazon during trading are a little bit wider. The wider the bid-offer spread, okay, the wider the markets and the options, the more effective these trading firms are going to be. As I was saying a moment ago, where does that leave you, okay, as a retail client? Hop on and go for the ride, okay? And in every stance, you can hop on and go for the ride. But let's get to the meat of this. Let's get to how it really relates to you. It relates a tremendous amount, okay, to the efficiency trade that's actually going on in the markets right now. When I say the efficiency trade, things and ways that you can take advantage of this. A moment ago in the video portion here, I talked about the SPX. So we're going to switch gears a little bit, even though this is still in kind of that edgy kind of quantitative finance. I'm going to show you this on a chart. So this is apparently where quants meet technical analysis. It's not any technicals in here, but this is really just a way of displaying what I'm talking about in terms of this quantitative move. Okay, starting back here, and this is for the most part back in April till right now, that's 22 weeks, of which we've got 1, 2, 3, okay? 3 effectively out of 22 have cracked outside of the expected move. Another way of putting that is 19 of 22 weeks we've actually stayed inside, which is the equivalent of about 86%. Now, when you look at these, and people are always looking for the data, when you're looking at these, you're supposed to have 68% of occurrences staying inside the deviation. Right now, 86% of them are staying inside of the deviation. This relates right back down to the quantitative finance. It's right back down to it. So the question that you have is, well, how can I take advantage of what you're saying in Amazon? Okay, it's not so much about Amazon. It's not so much about Microsoft. Okay, for you, it needs to be about the index products. So it's defining what kind of trades you want to do in the index products. And this is where I wanted to spend some time. Again, everybody's like, well, what do you think of the market? Right now, there's no fundamentals. There's no technicals. It's in control of quantitative finance. And you have to recognize that quants, they don't give a crap about direction. They just don't. They don't care if the marketplace went up 1,000 more points. Quants don't care. They're not trading because I really like the SPX at these levels. Okay. Everything to them is, how can I produce alpha? That's it. Like, alpha is just returns. How can I produce, returns no matter what the market direction happens to be? And what it's opening up in terms of opportunities for you, is the expected moves, the edge of the expected moves. The marketplace has become incredibly, incredibly efficient. And I'll talk about this week specifically because there's a number of great trades that opened up. If you tuned in to Wednesday's video, what did I say in Wednesday's video? Come in here and short right there. Why did I short it? Because we're coming back inside the expected move. How did I actually go in and short it? We used an in-out spread. We used an in-out spread. Watch the Wednesday video. It'll actually talk specifically about the in-out spread. It also elaborated upon the possibility of using what is termed a back ratio spread. Because if we're going to continue and explode back up to the upside, the back ratio, though, wasn't going to cost us anything. In fact, the back ratio happened to be for a 10-cent credit. The in-out spread looked for us to come right back inside of the expected move. And ironically, people, that's what we've done. We've come, again, right back inside of what was expected. So if we crack outside these expected moves, we have decent probabilities that we're going to actually come back inside of them. And this was a relatively profitable trade. It could have been done in the SPX. It could have been done in the spiders. But it had everything to do with the expected move. Now, the other trade that we're using very successfully, and we've had lots of clients that have really adapted to this, and this has everything to do with butterflies. A really simple area. Place butterflies right on the edge of the expected move. By the way, if you need the expected moves, you're a member of TheoTrade, come into the chat room. I'll provide these charts all day long. But the edge of this expected move happened to be 29.05. Do you realize where we closed? We closed right, off the edge of it. I mean, minutes into the close, we're trading 29.05 on the button. It doesn't get better for placing a butterfly right on top of it. It just simply doesn't get better than placing a butterfly right on top of the edge of an expected move. In this case, it's the upper edge of the expected move. And of course, we've done, class after class on placing butterflies on the edges of those expected moves. Now, moving forward. Let's move forward for a minute. Let's not worry about what we've done. Let's not worry about quantitative finance. What do we expect in the weeks to come? Okay. First of all, we have a 4-day trading week coming, but the 4-day trading week is carrying right around a $30 expected move, $30 higher, $30 lower. Okay. And that doesn't necessarily concern me at all. Like, oh, whatever, it's $30 move. Okay. What actually is getting interesting in just the last couple of trading sessions is we're gonna scroll out. You know what? Let me go over to the spiders. Make this a little bit easier, I think, to grasp in the spiders. Okay. What I'm going to show you here, again, pretty entertaining little area. If you look at like September options, 23 days out, like, oh, come on, 11% volatility. You're like, ooh, hurt me. It's like 11% vol. It's not totally dead out there, but it's kind of dead. But what I'm picking up on just the last few trading sessions, people, there's some volatility in them there hills. If you look at back month options right now in the spiders, the SPX, okay, the volatility is starting to pick up. All right, clearly they're looking at the election as being risk. Now, for those of you that remember back in 2016, the marketplace did a horrible job of pricing in the U.S. presidential election. Horrible job. They didn't even pick the volatility up until days before the election. I can go back in a future video and I'll show you that. But right now, they've already picked the volatility up. Listen, October, why is October 13.5 and all of a sudden November, which encompasses the election, is already jumped to 14.7. I would expect this to increase a little bit, but it's going to provide opportunity to be able to sell some premium. Okay. But here's one other interesting thing. When you start to get into September, October, people, these become much more volatile months. And one of the areas that you need to consider right now is that volatility ain't that high. Think about that for a second, because right now, I'm a net buyer of volatility. Again, that is over a longer duration. I'm a net buyer of volatility. How do you buy volatility? Risk twist spreads. How else do you buy volatility? VIX volatility spreads. For those of you, if you have portfolios right now, hedge them. Use an atomic hedge. You got to look into the archives, know the strategies. Okay. If you have questions, shoot us an email. We can help you get your portfolio hedged, get yourself long volatility right now. I'm not here to promote the fact that I think the market's going to tank. It's not about that. It's about the fact that we're coming into what has historically been some of the more volatile months. We've got all kinds of headwinds in volatility. I mean, take a look at this. Volatility, 23 days out. Come on, 11%. It's nothing. I want to be a net buyer of volatility. I'm not selling premium in the short term. I think that's an absolute, hideous mission to try to sell premium in the short duration. You want to sell some premium? Look a little further out in time, because that's where the juice happens to be. With that, thanks everybody for joining us here at TheoTrade. Have a wonderful holiday weekend. Summer is coming to a close. People, we're getting back to work on Tuesday. Have a good weekend. Bye-bye.